The 18th century scam that nearly bankrupted Britain. What if a nation didn't collapse because of war, famine, or invasion, but because it believed a story that sounded just plausible enough? In the early 18th century, Britain was not celebrating victory. It was counting debts. Years of continuous warfare had left the country financially exhausted. The War of the Spanish Succession had expanded Britain's influence, but it had also created a problem no one could ignore anymore: an enormous national debt. By 1710, the British government owed sums so large that even seasoned financiers struggled to explain how the state would ever repay them. Taxes were already high, public trust was fragile, and default, something that could shatter Britain's reputation across Europe, was a real fear. This was not a society looking for innovation. It was a society looking for relief. At the heart of the problem was a simple but dangerous question: how do you make debt disappear without admitting failure? The British government's answer was not austerity. It was not restraint, it was financial creativity, the kind that sounds elegant on paper and catastrophic in reality. Instead of paying off its creditors directly, the state began searching for a mechanism that could transform debt into something else, something more attractive, something that could be sold not as a burden, but as an opportunity. This is where finance stopped being boring and started becoming seductive. Government debt was no longer framed as a problem, it was reframed as potential. If handled correctly, it could be converted into profit, growth, and national prosperity. All it needed was the right intermediary, a company, a structure, a promise large enough to make people forget the risk. Britain had already seen how powerful speculation could be. London was growing fast. Coffee houses doubled as financial hubs. Information traveled through whispers, pamphlets, and rumors long before it reached official channels. Markets were informal, emotional, and deeply human. And humans, when desperate, are willing to believe. The idea that would soon captivate the nation did not begin as an obvious scam. In fact, it sounded responsible, rational, even patriotic. A private company would assume a large portion of government debt. In return, it would receive exclusive commercial privileges that would supposedly generate enormous profits. The logic was simple: trade would pay for the debt. Growth would solve the crisis. Everyone would win. At least that was the story. What almost no one asked, not seriously, was whether those promised profits were realistic, whether the trade routes existed, whether the political conditions allowed them, or whether the company itself had the capacity to deliver anything at all. Those questions were inconvenient, and inconvenient questions rarely survive periods of financial stress. Instead, the country focused on hope, on recovery, on the comforting belief that Britain had found a way out that didn't require sacrifice. This was the moment before belief turned into obsession, before optimism hardened into certainty, before doubt became socially unacceptable. The solution to Britain's debt crisis had a name, and soon that name would be on everyone's lips. But before the market exploded, before fortunes were made and destroyed, we need to understand how a struggling government laid the groundwork for one of the greatest financial delusions in history. If you want to follow this story to its end and see how a nation convinced itself that paper promises were worth more than reality, make sure to subscribe to the channel and like this video. It helps more people discover these stories, and it ensures you don't miss what happens next. The solution to Britain's debt crisis did not come from a bank. It came from an idea that sounded almost elegant. In 1711, a new entity entered the financial landscape: the South Sea Company. On the surface, its purpose appeared straightforward. The company would take over a significant portion of Britain's national debt. In exchange, it would receive exclusive trading rights in South America, a region widely imagined as unimaginably rich, overflowing with silver, gold, and exotic goods. To a government drowning in obligations, this sounded less like speculation and more like salvation. The arrangement worked like this: government creditors would swap their state-issued debt for shares in the South Sea Company. Instead of relying on uncertain tax revenues, investors would now benefit from the company's future profits. The state, in turn, reduced its immediate financial burden. Everyone seemed to gain. On paper, what gave the plan credibility was not its realism, but its presentation. The company was backed by Parliament. It was framed as a national project. This was not a shadowy venture operating on the fringes of the market. It carried official approval, political protection, and the implicit message that it was too important to fail. That distinction mattered. In early 18th century Britain, information was fragmented and trust was scarce. People relied on signals, endorsements, titles, royal connections to decide what was safe. And the South Sea Company had all of them. Its directors were well connected, its charter was public, its mission sounded patriotic. But behind the language of commerce and empire, there was an uncomfortable truth. The company's business model rested on assumptions that were, at best, optimistic. Britain did not control South America. Spain did. Trade access depended on treaties, permissions, and fragile political arrangements. Even when limited trade was allowed, it was heavily restricted. The idea that vast, consistent profits would flow into British hands was more fantasy than forecast. Yet these details rarely made it into public discussion. What people saw instead was the promise. The word monopoly carried enormous weight. Exclusive access implied certainty, and certainty in uncertain times is irresistible. The South Sea Company did conduct some trade, enough to appear legitimate, enough to maintain the illusion that profits were not just possible but imminent. Annual reports hinted at future expansion. Directors spoke confidently about opportunities that were about to open. The language was carefully chosen, always forward-looking, never specific. This vagueness was not accidental. The company did not need to succeed in trade immediately. It only needed to succeed in belief. As long as people trusted the future, the present could be ignored. And that trust began to grow. Shares circulated. Conversations spread through London's coffee houses. Investors spoke less about ships and cargo and more about price movements. The company's actual operations faded into the background, replaced by a simpler narrative. The South Sea Company represented progress. It represented recovery. It represented a way out. But beneath the optimism, something subtle was happening. The value of the company was drifting further away from the reality of its business. Expectations were rising faster than evidence. Confidence was becoming detached from facts. This gap between what the company was and what people believed it could be would soon define everything that followed. Because once belief replaces verification, markets stop asking whether something is true and start asking only whether others will believe it too. And that shift was already underway. By the middle of the second decade of the 18th century, the South Sea Company had secured something far more valuable than ships or trade routes. It had secured attention. Britain's financial public was no longer focused on balance sheets or treaties. Conversation had shifted. In coffee houses, in private letters, and in drawing rooms, the company was discussed not as a trading enterprise, but as a future certainty. The language surrounding it became increasingly confident, even as concrete evidence remained scarce. This shift did not happen by accident. The company's directors understood a crucial truth about markets in times of uncertainty. People do not invest in facts alone. They invest in narratives. And the narrative being quietly constructed around the South Sea Company was carefully designed to feel inevitable. South America was described not as a complex political landscape, but as a distant vault of untouched wealth. Silver mines, exotic commodities, and limitless demand were implied rather than proven. The obstacles, Spanish control, fragile treaties, logistical constraints, were rarely emphasized. When they were mentioned, they were framed as temporary inconveniences. The future, investors were told, would take care of itself. What made these promises especially powerful was their ambiguity. No precise figures were offered, no timelines were guaranteed. Instead, the company spoke in terms of potential, expansion, and opportunity. This allowed each listener to imagine profits on their own terms. Optimists heard inevitability, skeptics heard possibility, and both felt just enough reassurance to stay quiet. At the same time, Britain was experiencing a cultural shift in how wealth was perceived. Speculation was no longer seen purely as gambling. It was increasingly framed as participation in national progress. To invest was to believe not just in a company, but in Britain's future as a global power. Doubt in this environment became socially uncomfortable. Those who questioned the company's real prospects were often dismissed as unimaginative or overly cautious. They were told they did not understand modern finance. Or worse, that they lacked faith in Britain itself. And so belief began to reinforce itself. As more people accepted the narrative, the need for proof diminished. The absence of bad news was interpreted as good news. Silence was read as confirmation. Each passing month without visible failure strengthened the assumption that success was only delayed, not doubtful. This psychological shift marked a turning point. The South Sea Company no longer needed to demonstrate profit. It only needed to maintain confidence. And confidence, once established, investors can be remarkably resilient, even when disconnected from reality, but belief alone cannot support a market forever. Soon the company would take a step that transformed quiet optimism into something far more dangerous, a step that would bring the government closer, draw in powerful allies, and turn a promising story into a national obsession. And once that happened, doubt would no longer be merely discouraged. It would become almost impossible. By the year 1720, the South Sea Company had captured more than public attention. It had captured influence. Its reach extended beyond investors and coffee houses. Politicians, ministers, and even members of the royal court were drawn into the story. The government's own support made the company appear untouchable, a pillar of national strategy rather than a speculative venture. When those at the highest levels placed trust in a company, ordinary people were quick to follow. Authority became a signal of legitimacy, and legitimacy was now more persuasive than facts. The British government had already committed to exchanging significant portions of national debt for shares in the company. Parliament debated, approved, and endorsed these arrangements. The result was a tacit message: if lawmakers, advisors, and royalty believed this could work, it must be safe. Skepticism became socially inconvenient, even dangerous. To question the company was to question the nation itself. The involvement of power did more than reassure the public. It created a feedback loop. The more authority figures invested, spoke favorably, or were photographed with company directors, the more ordinary investors felt compelled to participate. London's financial community transformed overnight into a theater of expectation. Rumors about shipments of silver and sugar, of lucrative contracts in faraway colonies, spread quickly. Coffee houses were alive with stories of untold fortunes. Every whisper reinforced the idea that opportunity was not just available, it was imminent. At the same time, the company's directors understood how to leverage this influence. Meetings were orchestrated to showcase their connections. Public statements were timed to reassure skeptics while inflating expectations. Charts of supposed trade prospects were circulated in pamphlets and newspapers, showing potential profits without any real operational data to back them up. Ambiguity, once again, became a tool. The company was careful not to make promises it could be held to, but it framed every statement to imply inevitability, and the public responded. Investors who might have paused to verify the feasibility of South American trade instead rushed to purchase shares. Nobles, merchants, and everyday citizens alike sought to join the scheme before it was too late. Entire families mortgaged estates, borrowed money, and sold possessions. The financial press, eager to avoid contradicting official sources and swept up in the excitement, often repeated the most optimistic projections as facts. It was a classic example of authority amplifying belief. By tying the company's narrative to the nation's economic health, the line between personal opportunity and national destiny blurred. People were not just investing in a company, they were investing in their country, in their society, in their perceived role in the larger story of Britain, and that made doubt almost impossible. But influence has a limit, and even the strongest endorsements cannot change the realities of trade, politics, and human greed. While Parliament and the royal court provided credibility, the actual business of commerce remained fragile, subject to delays, failures, and political obstacles. Yet the public perception, reinforced by authority, convinced investors that these obstacles were minor, temporary, and surmountable. Confidence was no longer merely encouraged. It had become an obligation. To step back was to appear naive, unpatriotic, or unimaginative, and when the first cracks began to appear, they would be noticed by few, overshadowed by the overwhelming chorus of faith. By the end of this stage, Britain was on the cusp of transformation. The South Sea Company was no longer a business. It had become a symbol, a story, and a social imperative. The next moves would push optimism toward obsession, and obsession toward a scale that the nation had never seen before. And just as certainty seemed absolute, subtle signs of strain began to appear, whispers that not all was as it seemed, but few dared to listen. The question now was simple: how far would a nation follow its leaders into a financial dream before waking to a nightmare? And that is where our story begins to accelerate. By 1720, the South Sea Company had moved beyond financial maneuvering and official endorsement. It had become a cultural phenomenon. Shares were bought not merely as an investment, but as a statement. To own a portion of the company was to signal participation in Britain's future, to assert that one understood progress, wealth, and opportunity before others. The company's narrative had become contagious, and the marketplace was the perfect environment for such contagion to spread. The transformation of investor behavior was striking. Previously cautious merchants, tradesmen, and even minor nobles began speculating at unprecedented levels. Ordinary citizens mortgaged property, borrowed from neighbors, and sold heirlooms to acquire shares. The streets and coffee houses of London were abuzz with stories of imminent riches. Prices, which in rational conditions would have reflected actual trade and profit potential, instead became a reflection of human expectation, rumor, and excitement. Consider this. In a matter of months, shares that had been issued at a nominal value quadrupled, then quintupled, not because of tangible success, but because each new investor assumed the next would pay more. The stock market itself became a theater of psychology, where perception mattered more than reality. People were no longer buying commodities or goods. They were buying belief. Media, although rudimentary by modern standards, played a critical role. Pamphlets, newspapers, and word of mouth amplified every positive signal and minimized dissent. Reports of profitable trade expeditions, however rare or exaggerated, were circulated as evidence of inevitable success. Skeptics were drowned out or accused of lacking foresight. Rational analysis was replaced by social proof, a potent force in times of economic hope and nationalistic pride. What fueled the fever further was accessibility. Previously, speculative opportunities were limited to the elite. Now, the South Sea Company had made its shares available to a wider public. This democratization of speculation intensified the frenzy. Suddenly, ordinary people felt they could participate in history. To abstain was to risk missing the largest fortune Britain had ever seen. And with opportunity came stories. Stories of individuals who had made extraordinary gains overnight. Anecdotes of sudden wealth spread faster than the facts. Ordinary people saw neighbors suddenly moving into grand houses or acquiring expensive goods, reinforcing the belief that fortune was not just possible, but nearly guaranteed. Every success story, no matter how isolated, became proof of the system's validity, yet the mechanics of the company's operations had changed little. Trade remained limited and uncertain. Profit generation was marginal compared to the valuations the market was placing on shares. The gap between reality and perception widened with every passing week. Investors, caught in the excitement, either failed to notice or chose not to acknowledge the discrepancy. This was the moment when optimism hardened into conviction, when belief was no longer a personal choice, but a collective imperative. The social and psychological pressure to participate, to succeed alongside one's peers, became almost irresistible. The market was no longer about commerce. It had become about conformity, status, and the fear of being left behind. And as in every fevered market, the question of sustainability was conveniently ignored. Rational caution became socially discouraged. The more people believed, the more impossible it seemed to step aside. The very act of selling was perceived as a betrayal, not just of oneself, but of the collective faith that had built the frenzy. By the close of this stage, Britain's financial landscape had changed irrevocably. What began as an attempt to manage national debt had evolved into a social phenomenon, a mass delusion, and a psychological experiment on an unprecedented scale. The stage was now set. The market's momentum was unstoppable, and the next steps would push both the country and its people toward extremes they could not yet imagine. But beneath the excitement, subtle warnings were emerging. And those who noticed them were already asking, could this fever ever end without catastrophe? The answer, as we will see, would not be long in coming. By 1720, the South Sea Company had become more than a financial enterprise. It had become an ecosystem. Investors of every social class, from wealthy merchants to minor gentry, had placed their hopes, savings, and inheritances into a venture that existed largely on faith and expectation. Yet within this frenzy, other opportunists saw a chance to profit. A wave of secondary schemes emerged, riding on the company's reputation. These were smaller enterprises, some barely more than paperwork, promising access to South American riches, secret mines, or monopolies on exotic goods. Unlike the South Sea Company, which had at least a veneer of legitimacy backed by Parliament, these ventures operated in the shadows, exploiting the public's growing appetite for profit. What made these side schemes dangerous was not just their illegitimacy, but their resemblance to the larger enterprise. Investors, swept up in the excitement, often failed to distinguish between official shares and speculative side projects. The boundary between a sanctioned investment and a fraudulent scheme blurred. People assumed that any venture associated with South America or exotic trade carried the implicit endorsement of the South Sea Company, even when there was none. One particularly audacious example involved a company that promised to fund a fleet fleet for the purpose of extracting silver from a remote island, a place many had never heard of. Investors were given elaborate maps, charts, and letters of intent, all designed to appear credible. They paid dearly for shares, not realizing that the fleet existed only on paper. Others offered futures on yet-to-be-discovered mines or exclusive rights to commodities that could not yet be traded legally. The psychology driving participation was familiar by this point. Investors had seen their neighbors profit, had heard whispers of success in London's coffee houses, and had received reassurance from authority figures. Social pressure and the fear of missing out became stronger than any rational analysis. Even those who suspected fraud often hesitated to act. To do so was to risk social embarrassment, to appear unambitious, or to admit that one had been wrong. Interestingly, the South Sea Company itself did little to discourage these imitators. Its directors were aware that the surrounding hype indirectly reinforced the value of their own shares. The more people were eager to invest in any venture promising South American wealth, the more legitimate the original company appeared. In effect, these smaller schemes acted as free marketing, feeding the larger delusion. Yet cracks were beginning to form, subtle but undeniable. Not every expedition produced results. Reports of delays, losses, and logistical impossibilities circulated quietly. Some letters from merchants and traders hinted at practical challenges that no investor wanted to acknowledge. But the excitement was so intense and the stakes so high that most chose to ignore or reinterpret these warnings. Every failure was reframed as a temporary setback, a minor obstacle in the path to inevitable wealth. By now, the market was not merely speculative, it was performative. Buying shares was a public act, signaling confidence, loyalty, and ambition. Selling was increasingly seen as betrayal, and the more people invested without questioning, the more the illusion of inevitability strengthened. The danger of this environment was clear. Reality could be vastly different from perception, and the gap between the two was widening. Each new scheme, each new investor reinforced a system that was increasingly divorced from actual commerce, relying instead on trust, rumor, and psychological contagion. As this web of speculation expanded, Britain teetered on the edge of a financial phenomenon unlike anything it had experienced before. The next chapter would show how the first cracks in this fragile illusion began to appear. Small tremors that few noticed, but which would eventually trigger a wave of consequences felt across the entire nation. And when those tremors became impossible to ignore, the country would face a moment it could never forget. By 1720, Britain's financial landscape had been transformed. The South Sea Company was no longer merely a business. It had become a social force. Coffee houses buzzed with news of rising shares. Streets were filled with chatter about fortunes made overnight, and families mortgaged property or sold assets to join the frenzy. Optimism had hardened into collective conviction. Belief in the company had become almost unquestionable. Yet even in the most fervent bubbles, subtle signs of strain emerged first as whispers, then as patterns, and finally as undeniable cracks. In the case of the South Sea Company, these early tremors were easy to overlook, yet they were there for anyone willing to see. Reports began circulating that some trade ventures were failing to deliver expected returns. Ships sent to South America returned with minimal cargo. Costs were higher than anticipated. Treaties with Spanish authorities necessary for legal trade were fragile and inconsistently enforced. Each of these incidents individually might have seemed minor, but collectively they hinted at a growing disconnect between the company's promises and reality. Investors, however, rarely paused to analyze these signals. Confirmation bias was now entrenched. Every minor success or rumor of profit was amplified. Every setback was dismissed or rationalized. The social pressure to remain confident was immense. To question the company's viability was to risk ridicule, to appear short-sighted, or even unpatriotic. Skepticism became a dangerous sentiment in a society gripped by collective hope. Meanwhile, insiders quietly adjusted their strategies. Some directors began to sell portions of their own shares, realizing that the market's perception could be manipulated to create temporary peaks in price. Others encouraged exaggerated projections of trade profits to maintain momentum. The gap between internal knowledge and public perception widened. The illusion of prosperity became more fragile with every deliberate misrepresentation, yet outwardly, the story remained compelling. At the same time, the secondary schemes, smaller companies promising South American riches, continued to proliferate. These ventures drew capital away from legitimate trade, further weakening the system's foundation. Investors, intoxicated by the fever, failed to differentiate between solid opportunities and empty promises. Each new speculative enterprise acted like a magnifying lens, intensifying the sense that success was inevitable and ubiquitous. Psychologically, the bubble had reached a critical phase. Fear of missing out eclipsed prudence. Investors who might have sold shares at a reasonable profit held on, anticipating further gains. The very act of selling was stigmatized. Rumors of early sellers being shamed or ostracized reinforced conformity. The market was no longer about evaluating tangible assets. It had become a social performance. Yet beneath this performance, reality quietly exerted pressure. Trade remained limited. Logistical challenges persisted. Political constraints in South America had not disappeared. And while public confidence was soaring, the underlying fundamentals were eroding. Each week of inflated valuations further detached share prices from real-world commerce, creating a fragile tower of belief. The tension between perception and reality was mounting. Early tremors were appearing, yet most investors were blind to them, lulled by the allure of sudden wealth and reassured by authority. The cracks were subtle, but they were growing, and history shows that no structure built purely on faith can withstand relentless pressure indefinitely. Soon, those tremors would grow into waves, and when they did, the consequences would reach far beyond the coffee houses of London or the offices of merchants. Families, estates, and fortunes that seemed secure would be swept aside in a tide of panic and disillusionment. The question was no longer whether the bubble would burst, only when and with what force. And that moment when belief and reality finally collided would change Britain forever. By the spring of 1720, the South Sea Company had reached heights that would have seemed unimaginable only a few years prior. Shares had risen to extraordinary valuations, fueled not by trade profits, but by collective belief, rumor, and the sheer momentum of speculation. Investors, from minor tradesmen to wealthy nobles, were convinced that prices could only rise. Confidence had hardened into near certainty, yet the very factors that had driven the frenzy, speculation, social pressure, and faith in authority, were also the forces that made the system unstable. Financial history, after all, demonstrates a simple truth. Markets built on expectation rather than substance are inherently fragile, and in the spring of 1720, the first cracks became impossible to ignore. The trigger was deceptively small. A series of minor reports suggested that some South American ventures were failing to generate the expected revenue. Ships returned late or empty. Costs exceeded initial projections. These setbacks, though modest in isolation, signaled a potential discrepancy between the company's promises and reality. What might have been manageable in a stable market became catastrophic in an environment dominated by hype. As these reports reached London, panic began to spread quietly at first. Certain investors, recognizing the mismatch between reality and perception, started to sell shares. Others, eager to avoid losses, followed. The moment one significant investor acted, it became a signal, a cue that doubt was permissible, even urgent. Markets, particularly those fueled by psychology rather than fundamentals, can shift violently once perception changes. The selling accelerated. Prices, which had been rising steadily for months, began to tumble. What had been viewed as an inexhaustible well of wealth now appeared suddenly fragile. Investors who had once ignored inconvenient details now scrutinized every statement, every shipment, every rumor. The social imperative to believe, so powerful for so long, began to weaken. At the same time, the South Sea Company attempted to contain the panic. Directors issued statements reassuring investors that setbacks were temporary, that profits were still on the horizon, and that the company's fundamentals remained strong. But in a market driven more by emotion than logic, words were powerless. The very attempt to calm the crowd often had the opposite effect, signaling that something was wrong and that insiders might be aware of danger before the public. By the afternoon, the selling had become widespread. Shares lost a substantial portion of their value in a single day. Wealth that had seemed secure vanished almost instantaneously. Families who had invested everything found themselves exposed. Entire estates were mortgaged or liquidated to cover losses. The illusion of prosperity collapsed faster than it had been built. Psychologically, the collapse was devastating. For months, investors had interpreted setbacks as temporary. Hope had replaced evidence. Social pressure had discouraged skepticism. Now the gap between perception and reality could no longer be ignored. Panic replaced optimism, and fear spread faster than any rumor of profit had before. before. This sudden reversal illustrates a fundamental principle of speculative bubbles. They can grow quietly for years, sustained by belief and social reinforcement, but when the first significant event challenges that belief, the collapse is swift and brutal. The structures that had seemed invincible, reputations, estates, and even social standing, were suddenly vulnerable. The fall of the market did not just affect investors, it rippled through society. Banks faced liquidity issues, merchants lost capital, the government, which had endorsed the company and absorbed debt through its shares, now confronted a financial crisis. The consequences of faith built on assumption rather than substance were becoming undeniable. Yet even as chaos spread, the story was far from over. The initial crash was only the beginning. Those who had been responsible, insiders, directors, and politicians, faced scrutiny, and the search for accountability would begin. And amid the turmoil, one question lingered. Could the system recover, or had the illusion of wealth destroyed more than money? The stage was set for Britain to confront the human cost of its collective belief, and the reckoning, when it came, would be impossible to ignore. Next, we will explore the aftermath, how society, government, and individuals faced the consequences of the bubble, and who would ultimately bear the brunt of this financial collapse. The South Sea bubble had burst, but the consequences were only beginning to unfold. By the summer of 1720, the market had already lost vast sums in mere weeks. Shares that once seemed a ticket to wealth now represented ruin. Families who had invested everything found themselves destitute. The social and psychological impact was as severe as the financial damage. The collapse was not a single event, but a process. Panic spread rapidly across London and other financial centers. Banks faced sudden demands for liquidity, many unable to cover withdrawals. Merchants previously flush with capital found themselves burdened with debts. Estates were sold, mortgages defaulted upon, and reputations were destroyed. The illusion that had sustained confidence for years was gone, and with it, the certainty of personal security. Yet the public reaction was more than financial. Society demanded accountability. Newspapers and pamphlets, which had once amplified optimism and speculation, now became instruments of outrage. Directors and insiders, some of whom had quietly profited before the crash, were accused of fraud, manipulation, and collusion. Parliament, embarrassed by its previous endorsements, faced pressure to investigate. Public trust in institutions, both governmental and commercial, had been severely undermined. The human cost was staggering. Reports of suicides, ruined marriages, and shattered livelihoods filled the letters and diaries of the period. Ordinary citizens who had invested their life savings were devastated. Even those who had only partially participated in the speculation felt the psychological weight of collective failure. Social hierarchies were temporarily disrupted as wealth that had symbolized status vanished overnight. Behind the headlines, patterns emerged that offer insight into human behavior during crises. The bubble had been fueled not only by greed, but also by social conformity, trust in authority, and the fear of missing out. Once those forces reversed, the same psychological mechanisms accelerated the collapse. Investors sold in waves, each transaction feeding the panic of the next. Confidence, which had been the market's lifeblood, became its poison. The government, which had relied on the company to absorb debt, now faced a dilemma. It needed to stabilize the economy without appearing complicit in the disaster. Measures were taken to provide limited relief to those most affected, but accountability was selective. Insiders with connections often escaped full punishment, while ordinary investors bore the brunt. The resulting perception of injustice compounded societal resentment. Yet, even amid disaster, some learned lessons were hard to ignore. The collapse highlighted the dangers of speculation divorced from reality, the vulnerability of collective belief, and the consequences of placing faith in unverified promises. It demonstrated the power of narrative over evidence and the speed at which hope can transform into ruin. Still, while the immediate crisis had struck, the story of the South Sea bubble was not finished. Its legacy would echo in political debates, economic theory, and the collective memory of Britain for decades to come. Investors would continue to grapple with trust, risk, and greed, applying the lessons or repeating the mistakes in subsequent generations. The nation had faced the destructive potential of mass belief and unchecked optimism, but who exactly would be held accountable? And could any lesson from this catastrophe prevent a recurrence? In the next chapter, we will explore the search for those responsible, the insiders, politicians, and financiers whose actions magnified the disaster, and examine how justice and retribution unfolded in the aftermath of Britain's most infamous financial bubble. After the collapse of the South Sea bubble, Britain was left in shock. The market had imploded, fortunes evaporated, and the families were devastated. Yet the immediate concern of society was not only recovery, it was accountability. People demanded answers. Who had manipulated the system? Who had profited at the expense of ordinary investors? And could justice be served in a case so vast, complex, and intertwined with power? Parliament responded swiftly. Committees were formed to investigate the collapse. Directors, financiers, and politicians were called to testify. The process was meticulous, intended to uncover how a company, initially backed by official authority, had become the epicenter of financial ruin. Investigators examined correspondence, contracts, and ledgers, seeking evidence of fraud, negligence, or collusion. The findings were sobering. Many directors had taken advantage of the frenzy, selling their shares before prices collapsed. Their profits were immense, while the public bore the losses. Others had manipulated information, issuing overly optimistic reports and hiding setbacks to maintain confidence. Yet proving criminal intent was challenging. The legal framework for financial oversight was rudimentary, and many practices, though ethically dubious, were not strictly illegal. Politicians and government officials were also implicated. Some had accepted shares as gifts or incentives, blurring the line between public duty and private gain. Parliament had endorsed the scheme, creating a perception of legitimacy that encouraged widespread investment. Critics argued that authority figures had failed to exercise due diligence and in some cases had actively facilitated the bubble for personal advantage. Public outrage grew as the investigation revealed that responsibility was not evenly distributed. While some financiers faced punishment, others escaped with their wealth intact. Ordinary citizens who had invested based on public trust and social pressure suffered the greatest losses. The perceived injustice fueled resentment against both the financial elite and the government. The South Sea bubble was no longer merely a financial event. It had become a political and social crisis. The consequences for those found culpable were significant but selective. Several directors were imprisoned, stripped of property, or fined heavily. Politicians implicated in misconduct faced public censure, lost positions, and reputational damage. Yet many influential figures managed to retain wealth and social standing, highlighting the limits of accountability in a society where power and connections often outweighed law. Beyond individual punishment, the aftermath revealed lessons about systemic vulnerability. The bubble had exposed the dangers of speculation based on perception rather than reality, the risks of intertwining government authority with private enterprise, and the psychological mechanisms that drive collective belief. These lessons, recorded in reports and debates, would inform British finance for decades, shaping regulations and public expectations. However, the story was far from concluded. Even as justice was selectively applied, the public's fascination with wealth, speculation, and rapid profit persisted. The allure of quick gain, reinforced by previous stories of extraordinary returns, ensured that the South Sea bubble would not be remembered solely as a warning. It would also serve as a template for future ambition, greed, and inevitably risk. The nation had confronted both human ambition and human folly, and while some retribution had been exacted, the underlying forces that created the disaster remained. And this raises a critical question. If the same patterns of belief, authority, and greed are repeated, could another bubble rise from the ashes of the last? In the next chapter, we will explore who truly benefited from the collapse, revealing how a handful of insiders turned disaster into opportunity, and what that says about human nature and the cycles of financial mania. In the aftermath of the South Sea bubble, most of Britain was left devastated. Families who had mortgaged estates or sold possessions faced ruin. Merchants lost capital that had taken decades to accumulate. Public trust in financial institutions and government credibility suffered a severe blow. Yet amid the chaos, a small group of insiders emerged remarkably unscathed and some even richer than before. The directors of the South Sea Company were the most obvious beneficiaries. Months before the market collapsed, many had quietly sold shares at inflated prices, transferring risk to unsuspecting investors. This was not a result of luck alone. It was the product of careful observation, access to privileged information, and the strategic exploitation of public psychology. The company's leadership understood that as long as optimism remained contagious, share prices could be manipulated to create personal gain. Political figures also benefited, though more subtly. Certain members of parliament and government officials had acquired shares or received indirect incentives for their endorsement of the scheme. Their support lent legitimacy, encouraged widespread participation, and amplified the illusion of inevitability. When the bubble burst, their losses were often minimal, while ordinary investors carried the brunt. Influence in this case became a form of protection. Interestingly, the aftermath also created opportunities for opportunists outside the company. Financial intermediaries, brokers, and even journalists who had played a role in amplifying expectations found ways to profit. Some accepted commissions or insider tips, others capitalized on panic selling, purchasing assets at rock-bottom prices. The market's collapse, while disastrous for the majority, created pockets of extraordinary profit for those who could anticipate or manipulate the shift in sentiment. This dynamic reveals a fundamental truth about financial manias. The distribution of risk and reward is rarely equitable. While the public bears losses collectively, those with information, connections, or a capacity for strategic action often emerge wealthier. The South Sea Bubble is a stark example of how perception, timing, and social influence can be leveraged to turn a widespread disaster into personal opportunity. Yet the psychological impact of this disparity cannot be understated. Ordinary citizens who trusted in authority, social proof, and the narrative of inevitable wealth were left disillusioned. They had been told they were participating in a national project in the future prosperity of Britain itself. Instead, they were the casualties of a system that rewarded foresight, cunning, and sometimes unscrupulous behavior. The sense of injustice intensified public scrutiny and fueled demands for reform. At the same time, the story of profit among insiders perpetuated fascination with the bubble. While the catastrophe demonstrated the dangers of unchecked speculation, the narrative of extraordinary gains ensured that these events were studied, remembered, and in some cases romanticized. The same mechanisms that led to ruined confidence, optimism, and the fear of missing out also created enduring legends of wealth and clever manipulation. Ultimately, the South Sea Bubble serves as both a cautionary tale and a lens into human behavior. Greed, trust, and social influence are timeless. Systems can be manipulated, fortunes can be built or destroyed in months, and yet history shows that these cycles repeat. Those who understand the dynamics can exploit them. Those who do not are left to absorb the consequences. As Britain grappled with the aftermath, one critical question remained: what lessons would be retained and which would be ignored in the pursuit of the next opportunity? In the next chapter, we will examine the long-term impact of the South Sea Bubble on Britain's financial institutions, regulations, and collective consciousness, and how a single episode of mass belief reshaped an entire economy for generations to come. The collapse of the South Sea Bubble left Britain reeling, but its impact extended far beyond immediate losses. Economically, socially, and politically, the effects were profound, and they reverberated for decades. The events of 1720 did more than devastate individual investors. They reshape public understanding of finance, risk, and trust. In the short term, the government faced an urgent task: restore confidence. Parliament implemented inquiries, punished a number of directors and officials, and attempted to reassure citizens that mechanisms were being put in place to prevent such a catastrophe from recurring. Yet, as history often shows, regulation is reactive rather than preventive. The initial reforms addressed symptoms more than causes. Oversight improved incrementally, but human behavior, greed, herd mentality, and susceptibility to authority remained unchanged. Socially, the South Sea Bubble became a lesson in collective psychology. Ordinary people learned the risks of speculation, yet the fascination with rapid wealth endured. The public discourse increasingly included cautionary tales, pamphlets detailing the events, and moralizing commentary. Writers, economists, and satirists used the bubble to critique both personal folly and institutional failures. It became a reference point for understanding human behavior under economic pressure. Financially, the bubble revealed vulnerabilities in the British system. Banks, merchants, and investors recognized that markets could be manipulated not only by supply and demand, but by perception and rumor. Share prices, it became clear, were not purely a reflection of underlying value. This insight slowly influenced investment strategies, accounting practices, and the approach of regulators, though such lessons would take decades to fully embed. The psychological imprint of the bubble was equally significant. Britain's collective memory retained the shock of rapid loss alongside the envy of those who profited. This duality, fear, and fascination shaped attitudes toward investment for generations. People became more aware of the risks inherent in chasing collective optimism, yet the allure of extraordinary gain continued to captivate imaginations, setting the stage for future speculative manias. Interestingly, the legacy was not limited to the financial or social spheres. Politically, the episode exposed the dangers of too close relationships between state authority and private enterprise. Parliament had unwittingly lent legitimacy to a scheme that relied on perception rather than substance. Trust in political institutions was tested, and future policymakers would tread more carefully when endorsing financial ventures. From an analytical perspective, the South Sea Bubble is instructive because it demonstrates recurring dynamics: the amplification of optimism, the concentration of risk, and the separation of belief from reality. Modern financial crises, whether stock market crashes, real estate bubbles, or cryptocurrency manias, echo these same patterns. Human behavior, it seems, is remarkably consistent across centuries, even as instruments and scales change. Yet while historians and economists often focus on lessons learned, the human drama remains compelling. Families were ruined, reputations destroyed, fortunes secretly accumulated, and the very notion of trust in markets was forever altered. The bubble was not just an economic event, it was a cultural and psychological turning point. As Britain began the slow process of recovery, questions remained unresolved. Could the nation truly insulate itself against the next speculative frenzy? Were reforms sufficient to prevent history from repeating itself? And more broadly, what does the South Sea Bubble reveal about human nature, our susceptibility to hope, fear, and the allure of wealth? The answers, it turns out, were already taking shape. In the final chapter, we will explore how the memory of the South Sea Bubble shaped Britain's financial future, influenced global markets, and left lessons that resonate even today, revealing the enduring tension between ambition and caution. The South Sea Bubble, which erupted and collapsed in the early 1800s, left Britain scarred but wiser. The immediate financial devastation had passed, but the social, political, and psychological consequences endured for decades. By 1722, the nation had begun to rebuild, but the memory of lost fortunes, broken families, and shaken trust lingered, shaping both policy and perception. Economically, the aftermath prompted changes in regulation and oversight. Parliament recognized that unchecked speculation, especially when coupled with state endorsement, could destabilize the entire economy. Laws were introduced to improve transparency in financial reporting, regulate share issuance, and curtail reckless trading. Though enforcement was imperfect, the principle was clear. Investors required protection from both internal deception and collective hysteria. These reforms laid the groundwork for modern financial oversight, highlighting the importance of institutional accountability in markets driven as much by psychology as by commerce. The bubble also left a lasting mark on investor behavior. Ordinary citizens, once swept up in the fever, became more cautious but not entirely skeptical. Stories of sudden wealth and secret profits lingered in the public imagination, creating a dual lesson. Fear of loss tempered impulsive decisions, yet the allure of rapid gain ensured that speculation remained an enduring feature of financial life. In essence, the South Sea Bubble illustrated a recurring pattern. Human ambition and desire for status frequently outweigh caution, no matter how costly the consequences. Politically, the episode revealed the hazards of intertwining state authority with private enterprise. Government endorsement had amplified credibility, encouraging participation and inflating share prices. In response, future policymakers were more circumspect in their engagement with private ventures. Trust in institutions, once shaken, took years to rebuild, and public debate over the role of government in finance intensified. The bubble had shown that legitimacy is powerful but fragile, and that misjudgment at the highest levels can have nationwide repercussions. Psychologically, the South Sea Bubble remains a case study in herd behavior, confirmation bias, and the dynamics of collective belief. Investors had relied on authority, social proof, and rumor to guide decisions, often ignoring reality. Once the market turned, the same mechanisms accelerated panic, producing a feedback loop of fear and loss. Modern behavioral finance draws heavily from episodes like this, demonstrating that patterns of optimism, overconfidence, and social conformity are neither new nor confined to any era. Yet the the most profound lesson may be cultural. The South Sea Bubble entered Britain's collective memory as a story of human ambition, folly, and resilience. It became a reference point in literature, satire, and economic theory. Writers chronicled the drama, economists analyzed its mechanics, and society used it as a cautionary tale to navigate the risks of future speculative episodes. The narrative of rapid gain, spectacular collapse, and selective profit continues to resonate, offering insight into the enduring tension between greed and prudence. Even today, the echoes of the South Sea Bubble are visible. Financial crises across centuries, from 19th century railway schemes to 20th century stock market crashes, reflect the same principles. Human belief often drives value more than underlying reality, and collective enthusiasm can escalate into widespread disaster. Understanding this history is not just academic, it is a guide to navigating the risks and opportunities of human behavior in markets. Ultimately, the South Sea Bubble teaches that no system, however carefully constructed, can entirely escape the influence of human psychology. Ambition, fear, hope, and greed shape markets as profoundly as policy or trade. Institutions can mitigate risk, education can inform decisions, and regulations can provide safeguards, but the core lesson endures. When collective belief eclipses evidence, the results can be extraordinary, for better or for worse. And so, as we reflect on the rise and fall of Britain's most infamous financial episode, one question remains. Will future generations learn from this cautionary tale, or are the cycles of speculation, belief, and human desire destined to repeat themselves again and again? The story of the South Sea Bubble may have ended, but its lessons and its warnings continue to shape the world of finance today.